Hi, so a lot of people are confused about preferred stock. So I'm going to give a little couple minutes on this. Preferred stock is another brand of equity. It's somewhat like common stock, but a lot of differences. So it is equity, but it doesn't have voting rights. It doesn't participate in stock splits or stock dividends. It doesn't have preemptive rights. So really the only reason you buy it is for that fixed dividend. So all preferreds, the way to know is it'll say an IBM 5% preferred. If it has a percentage on it, well, it's either a bond or a preferred. So it'll say bond or debenture if it's not, or it'll say preferred. So preferred stock is always going to have a percentage on it, like a 3%, 4%, 5%. Now, the par on this is $100. So par, 100 bucks, and 6% of that is going to be $6 a year. So it's $6 every year. I should have picked a better number, but they pay dividends 4 times a year. They pay a quarterly dividend. So it means there's $1.50 every year. That's what you should get. There are no guarantees of dividends ever, because who picks the dividend? Who decides when they're going to pay it? The board of directors. So they can go, you know what? We don't have the money, so we're not paying. So we got preferred is paying a fixed dividend every quarter. They don't have to pay it, but they're going to, because the only reason you buy preferred is for the income. So the other thing preferred has, it has all the same risks as bonds do. So preferreds, since they have a fixed dividend, they have interest rate risk. If rates go up, prices go down. They have inflation risk. As the prices of goods go up, you're still getting the same amount of money. It has reinvestment risk. All the money you're getting, you're going to reinvest, and if the rates are lower, you'll get less. If it's callable, that means the company can buy it back. You have call risk. Now, you don't really have default risk because it's not debt. But the same thing is if they have business risk, they go, we're not making money. We can't pay you this quarter. That's a risk. Now, there's different types. There's straight preferred. There's non-callable, which means they can't call it back, which is a great thing to have because then it can go on forever. There's no maturity date either. They have convertible, which means you can turn it into common stock at any time. That's the SIE. That's as much as you need to know. On the top offs, you might need to do the math. We have cumulative, which means if we miss a dividend. So we got to talk about that. So if we miss a dividend on a regular preferred, we can't pay the common because the preferred is senior to common. So if we miss that year, we can't pay the dividend. But if we make it to a new year, we have a clean slate. So if you didn't get paid in 2019, come 2020, they pay you, they pay the common, and they don't have to pay any of the 2019 stuff. Unless it's what they call cumulative. Cumulative means it accumulates pretty much. And it pays in arrears, which means they're going to pay back all the past dividends. If I'm the issuer and I didn't pay dividends for 10 years, before I can pay the common 1 penny, I have to make up all the past dividends for the last 10 years plus this year. So if it's a 5% dividend, I missed 2 years, I have to pay 15. 5 for the 2 years ago, 5 for last year, and this year. So that's 15 bucks. That's cumulative. Then the last one is participating. Normally preferred, if you have a good year, you get your 4%. You have a bad year, you get your 4%. You have a great year, still getting 4%, which maybe you're not so happy about. So they make a thing called participating preferred, where they pay you your 4%, then they'll go pay the common, and if they have a good year, they'll come back and give you more. So you get to sort of participate in the upward earnings of the company. If they do better, it's all written in the prospectus, which you should have read about. The prospectus is going to help you know what the rules are. So again, we have regular preferred, we have callable, not callable. Not callable, they can't take it back. Cumulative, participating. Now, anytime, if you have a regular straight preferred, it has the highest coupon. Anytime you add one of these features, making it non-callable or cumulative or participating or convertible, it's going to drop the price because I'm doing something for the investor. So the investor has less risk. I don't have to pay you as much. I hope that helps, and have a great day.